Welcome to Wall Street Wisdom, where we provide valuable insights and tips on investing and personal finance. In this video, we will discuss the impact of inflation on the stock market, and how to protect your investments from inflation risks. Understanding inflation and its effects on stocks. To start, let's define inflation and how it affects the stock market. Inflation is the rate at which the general level of prices for goods and services is rising. When inflation increases, the value of money decreases, which leads to a decrease in the purchasing power of consumers and investors. Inflation also affects the earnings and profits of companies, as the cost of production and wages may rise, while the prices of their products and services may not keep up with inflation. As a result, the stock market may experience lower returns and higher volatility, especially for stocks of companies that are more sensitive to inflation risks, such as commodities, real estate, and utilities. Strategies to protect your investments from inflation. So, how can you protect your investments from inflation risks? Here are some strategies to consider. Diversify your portfolio. One way to reduce inflation risks is to diversify your portfolio by investing in a mix of asset classes, such as stocks, bonds, real estate, and commodities. By spreading your investments across different sectors and industries, you can minimize the impact of inflation on any one sector. Diversification is a key strategy to manage risk and optimize returns in any investment portfolio. By investing in a mix of asset classes, you can spread your investments across different sectors and industries, reducing the impact of inflation on any one sector. For example, you could invest in stocks of companies that are less sensitive to inflation, such as technology or consumer goods companies, as well as bonds, real estate, and commodities. Diversification can also help you avoid the risk of investing too heavily in a single company or industry that may suffer from inflationary pressures. Invest in inflation-indexed bonds. Another strategy is to invest in inflation-indexed bonds, which are designed to provide a return that keeps pace with inflation. These bonds are issued by governments and corporations, and their interest payments and principal values are adjusted for inflation. Inflation-indexed bonds, also known as Treasury Inflation-Protected Securities, TIPS, are a type of government bond that is designed to protect investors from inflation. The principal value and interest payments of TIPS are adjusted for inflation based on the Consumer Price Index, CPI, so the return on these bonds keeps pace with inflation. This means that if inflation rises, the interest rate on TIPS will adjust accordingly, ensuring that investors receive a positive real return. Consider investing in commodities. Commodities, such as gold, silver, oil, and agriculture, are tangible assets that can provide a hedge against inflation. As the prices of commodities tend to rise with inflation, investing in commodities can help offset the erosion of purchasing power caused by inflation. Commodities are tangible assets that can provide a hedge against inflation, as their prices tend to rise with inflation. For example, the price of gold tends to increase when inflation is high, as investors turn to gold as a store of value. Other commodities that may perform well during periods of inflation include oil, agriculture, and industrial metals. You can invest in commodities through exchange-traded funds, ETFs, or mutual funds that track commodity indexes, or by purchasing individual commodities directly. Focus on high-quality stocks. During periods of high inflation, some stocks may be better positioned to weather the impact of inflation than others. For example, companies with strong brand recognition, pricing power, and competitive advantages may be better able to pass on the increased costs of production to consumers, while companies with weaker financials may struggle. You can identify high-quality stocks by analyzing factors such as earnings growth, dividend history, debt-to-equity ratio, and market share. Use a tactical asset allocation strategy. A tactical asset allocation strategy involves adjusting your investment portfolio in response to changing market conditions, such as inflation. For example, if you believe that inflation is likely to increase in the near term, you may allocate more of your portfolio to inflation-sensitive assets, such as commodities, and less to stocks or bonds that may be negatively affected by inflation. Similarly, if you believe that inflation is likely to remain low, you may allocate more of your portfolio to growth stocks or bonds with longer maturities. In summary, protecting your investments from inflation requires a proactive approach that takes into account your risk tolerance, investment goals, and market conditions. By diversifying your portfolio, investing in inflation-indexed bonds, considering commodities, focusing on high-quality stocks, and using a tactical asset allocation strategy, you can minimize the impact of inflation on your investment returns and preserve your purchasing power over time. As always, be sure to consult with a financial advisor before making any investment decisions. Inflation is a critical factor to consider when investing in the stock market. By understanding the impact of inflation on stocks and implementing strategies to protect your investments from inflation risks, you can achieve better returns and minimize your exposure to volatility. Don't forget to subscribe to our channel for more investing insights and tips. Thank you for watching.